Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com gives us the latest update on the markets, including crude, palladium, and Bitcoin. Crescat Capital CEO Kevin Smith takes a hard look at what's happening with China, including Chinese real estate, its financial system, and could China's banks just be the world's biggest Ponzi scheme? Lobo Tiggre from the independentspeculator.com delves into the prospects for uranium, gold, and junior miners. Plus, at the end of the show, we'll have company showcase updates from American Manganese CEO Larry Reaugh and Aben Resources President Jim Pettit. We'll talk to Ross Clark right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Well, it's good to be with you, Jim, and it's been an interesting week in some of the commodities.
What's going on with crude oil?
Well, it continues to just barrel along here, up through $62. This is what do we got here? Almost a 50% move off the bottom. I think it's 48% when I did my calculations, at the end of the day. And, this is coming off that 10-year cycle low. You tend to, in that fourth quarter of the years ending in 8, you put in an important bottom. And we did have the classic decline of 40%, 45% into December, coming off the summer highs. Now, this rally has been, honestly, it's been stronger, had a lot more staying power within the move than we expected. We have been bullish, but looking for minor corrections. So at the point where we look at it right now, it's retraced to close to 60% of the total decline from the highs that we saw in October down into the December lows, and up, as I say, about 48% off the lows. When I compare that to the other 10-year cycles, coming off the 1988 low, it was a 50% move off the bottom. 1998 was huge. That was 73%. And 08 was 58%. Into the first seasonal high. And those seasonal highs came in late March through late April. So here we are, first week of April, getting into a point where, it's getting a little bit pricey up here. But the corrections, when we look at them, are typically only about 3 or 4 weeks. They're not all that big. They come back and test the usually around the 50 or the 20-week moving average. So in this case, we're up around $62 plus. You're probably looking at support down around 56 at some point after we put in a high this month and maybe correct into May. So I think that's what you want to be looking at. And some of the oil stocks, especially in Canada, have been slow coming off the bottom, but are starting to show some pretty good resilience in here. And I think we'll be looking for some reasonable opportunities as we get into the month of May.
Well, I've noticed Western Canadian Select is roughly $10 off the world price. Is that a good enough price for Canada? Yeah,
this discount, considering we were in the teens and, at one point through $20 discount. It's been a really steady move here, sitting at as you say, around $10 now. Maybe been as low as $9 at one point. This is getting better, and I think this might be enough, especially for some of the drillers that we've been looking at. And we'll be putting that out in a report as we come through the next couple of weeks in preparation for potential buys.
Palladium had a huge charge not too long ago. What's going on with the two Ps, palladium and platinum?
The PGMs, the platinum group metals, you've had this, as you say, this huge move in palladium. Went from $800 up to $1,600 from August through March. The top end of the move, we got, what we call a trifecta. That's when we've got exhaustion alerts, so that's overbought signals in our proprietary model on daily, weekly, and monthly basis up when we were up at just through 1,500. So you've had your first hard correction in palladium down to 1,300, good oversold. It's had a bounce, and this is, the classic after a bubble. You get that first hard break, then you get a decent bounce. In this case, it was to about 1,425. And now we should be down and testing support again, I think maybe around 1,250. On the other side of the coin, platinum, which had been the underdog in the sector, based out in August, but didn't have nearly the same rally. But it has shown a lot of stability here in the last couple of months, and we've been talking about Sabapne and about platinum group metals as two stocks that were looking good in the early part of the year. Well, platinum itself has broken out of an 8-year downtrend resistance line as of this week. I mean, we go back to 2011. There's a great trend line on here. It's been in a channel with resistance around the $870 range. Popped through there. It looks as though now next move was probably over $1,000. So there's a pretty reasonable potential in the platinum. And if we look at the ratio of platinum versus gold, there you're looking at a ratio that's down to levels that haven't even seen back in the 1970s. You've got some major spike lows in platinum against gold, probably 4 or 5 of them in the last 40 years, and the extreme that we're at right now would suggest that there's some pretty decent potential for platinum to move, not only on its own, but also against the gold market. So the few stocks that are in that category are worth looking at, and they've had mild corrections within the last couple of weeks, just enough to produce minor oversolds for us, and look as though they would be ready to come to life.
Bitcoin, or as a friend of mine has just recently called it, Bite Me Coin. What's going on there?
Well, this was, a year and a half, well, not a year and a half ago, December of a year ago. We got all the classic exhaustion signals for a bubble. And that December the 19th, all our signals kicked in. And this has done, we put out a report on this one this week. We've had the classic unwinding of the bubble. We've gone from, $20,000 down to $3,500. And the unwinding of any bubble tends to be very, very repetitive in terms of what happens in the early stages of it, because you're taking care of excesses. It's a highly emotional period. People have become enthralled with whatever the new item is, whether it was tulips decades ago or centuries ago, whether it was the Nikkei or the NASDAQ. They've all had their big booms and busts. So at this point, when we look at the pattern that we've had in Bitcoin, the lows that were put in at the tail end of last year and this small basing that we've seen is just so similar to what we saw in the NASDAQ coming out of the 2002 bottom, Shanghai of 2 years ago, or even closer to 3D Systems, which was a darling back in 2014 and got devastated down to 2016. Each one of those, as it came out of its bottom, which is what we're seeing in Bitcoin right now, rallied up to its 200-day moving average, nice and simple calculation for anybody, and then went through a pause again. And that pullback, what you want to be looking for here is a move back to the 50-day moving average, because we've come within, I think, 20 points right now of resistance. It's been a pretty fabulous week or so here. Bitcoin is up the better part of 50% off its lows. So at this point, look for a correction in the coming weeks. But we probably have seen a major bottom put in place for Bitcoin. What the upside potential is, it's hard to say, but I think this is going to present some good trading opportunities now rather than just being an outright bear on it for the last year and a half.
Ross, do you have any publications coming up?
Well, we did a piece on the Bitcoin, and we will have another one on crude oil as we move through May, towards May. So the listeners can contact me at Ross Clark at chartsandmarkets.com.
Thanks a lot, Ross.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Crescat Capital CEO Kevin Smith next on This Week in Money.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Kevin Smith, founder and CEO of Crescat Capital in Denver. Welcome to This Week in Money, Kevin.
Thank you, Jim.
Of course, we know we can find you online at crescat.net. And can you tell us a bit about Crescat Capital?
Sure. We're a global macro asset management firm, and we manage three products, a cross-asset global macro hedge fund, a long-short equity hedge fund, and a long-only separate account that is a large-cap managed account that can also hold cash and gold. And we're really a thematic macro-type firm, and our macro process applies to all three strategies. It really revolves around developing models. We have equity models and macro models that we use to pick securities and develop themes, and we're tactical, and what that means is that it's very important for us to try to time business and economic cycles. And that's just a little bit about our firm.
How long have you guys been around?
We've been around since 2006.
So you've seen the best and the worst.
Well, my track record actually managing money goes back 20 years. So I've been through a few business cycles, and really have definitely been through the tech bubble, the tech bust, the housing bubble, the housing bust, and now what I think we refer to as the everything bubble. It's really a global central bank driven set of asset bubbles that apply to many different countries and many different asset classes.
Are you seeing economic signal indicators?
We have a number of valuation and economic timing indicators that we have put together into what is what we've developed that we call our macro model here, which is a 16-factor macro model for timing the U.S. business cycle and the U.S. stock market, and based upon that model, we've got 4 valuation factors and about 12 economic timing signals that are telling us that we are record overvalued and record late cycle when it comes to the U.S. stock market and the U.S. business cycle.
What do you see ahead for gold?
Well, with precious metals, we we believe that the fundamentals are lining up very well, the macro fundamentals for precious metals. And when you look at the global fiat monetary base, the amount of base money that central banks globally have printed, it's over $20 trillion U.S. equivalent. And normally the gold has followed the path of the global monetary base very closely, but it's diverged since 2011 in a significant way. And so, our valuation models actually got a $3,000 target price for gold today based upon the global fiat monetary base.
What's your position on silver?
And silver is of course, when gold gets into a bull market, silver gets into a raging bull market. They're highly correlated, and today silver is almost the cheapest it's ever been relative to gold. I think the gold to silver ratio is something like 85-1 right now, and the most it ever got was about 92-1 in the early 90s. And similarly to today, the early 90s was a period after a long bear market for gold, and a basing pattern had developed, and we think a similar situation is setting up today for both gold and silver.
Do quality gold and silver stocks tend to outperform gold and silver bullion?
Well, and just like silver tends to outperform gold in bull markets for precious metals, so do precious metals mining stocks tend to outperform the underlying metal, and it's for obvious reasons. It's a very capital intensive business, and the profit margins, the amount of free cash flow and earnings that can flow to the bottom line when the metal price is rising is, there's substantial operating leverage, if you will, in those types of businesses. And so the earnings growth and free cash flow growth can be substantial during gold bull markets. So yes, we like gold and silver mining stocks in addition to owning the underlying metal today.
Palladium really went on a skyrocket ride for a little while. Is it still going to be a hot metal?
Palladium, really got ahead of itself, we think, as the auto manufacturers moved to using palladium in catalytic converters because it was cheaper than platinum historically, and now palladium got almost twice as expensive as platinum recently. And now there seems to be some substitution going on, and platinum's starting to break out, and while palladium has been breaking down. So we prefer platinum over palladium today.
How many countries currently have a housing bubble, and is there a common denominator?
Well, there is a common denominator, and there are a number of countries today in housing bubbles. At Crescat, we had a lot of success back in 06-07, timing the peak of the U.S. housing bubble and getting short home builders and mortgage stocks and banks. And we think there's a chance to do that again with housing bubbles in China and Hong Kong, in Australia, and in Canada. And similarly for us, it's really a short theme for us that we're expressing through bank stocks in those countries.
Are the current real estate bubbles that the mainland Chinese have taken part in comparable to the same bubbles in the late 80s and early 90s the Japanese took part in?
There are definitely some parallels with the success of China and its growth in the last decade plus. There has been a lot of money created in China and their banking system, and a lot of capital outflows that have spilled out across the world. China's been responsible for 60% of the marginal GDP growth in the world since the global financial crisis. And a lot of that has come through excessive credit expansion, and a lot of the money has flowed out to help create some of these other housing bubbles in Australia and Canada and Hong Kong. And so absolutely that's been a factor.
Are there any lessons we could have learned from the Japanese experience with real estate?
Well, that's and of course that's what you asked was about the parallels to Japan. So Japan, was a similar situation back in the late 80s when we had the the Japanese were buying up real estate all over the U.S. and they bought Pebble Beach and some of the big hotels in New York, and very similar parallels to that have been going on with the Chinese buying hotels in New York and all of the money going into real estate in Canada and Australia as well. What happened in China was a leveraged speculative bubble in both stocks and in real estate, both within their country and in the money that they poured into real estate outside of their country. And when that bubble burst, it was a credit bubble. And when the bubble burst, as everyone knows now, Japan has had several lost decades, and the real estate market and the stock market in Japan has been in a long-term recession and consolidation almost ever since. But there's another similar parallel, we think, in terms of the aging population within Japan and China today. Japan of 1989 has the same peak of the workforce population that China has, and so there's a demographic element to the slowdown in growth that's likely to be coming from China on top of the credit bubble that country has and that Japan had back in 1989.
Are China's real estate markets and economy in trouble?
Absolutely. We think that the Chinese economy is going through a major slowdown right now, and one that we think could very well trigger the bursting of the credit bubble in China. Really is what it is, a credit bubble. Yes, there's of course the housing bubble in China too. There's 60 million empty apartment buildings in the major cities in China, and it's an incredible imbalance in the big cities, Beijing and Shanghai. The price to rent is something like 80 times multiple. The household debt to GDP, while those figures are higher in other housing bubble countries like Canada and Australia, in China there's a system-wide credit bubble in the banking system and a corporate credit bubble that is a troubling imbalance. But there's absolutely a housing bubble to go along with it. The Chinese, I think, have a faith that they can keep their wealth in real estate, that real estate always appreciates. But there was a story recently whereby I think it was China Evergrande dropped the prices of the homes it was selling, and there were literally riots in the street because of that, because the Chinese have been taught that real estate prices always go up, and they pour their life savings into it.
If China's real estate bubble bursts, what's that likely going to do to the psychology of the mainland Chinese that have bought up real estate around the planet?
Well, that's it's an interesting topic to think about and to speculate as to whether the money that has flowed out of China into real estate in other countries is likely to come back in a similar way to in Japan, when the real estate bubble burst there and the credit bubble in Japan burst. A lot of the Japanese money did come back to Japan, and so we didn't have a currency crisis in Japan, but we had a stock market crisis and a real estate crisis. In China, we think there's that the comparison is, in this sense, is not as much to Japan as it is more to other totalitarian communist countries in the past, whether it's the Soviet Union or Venezuela. The fact of the matter is that China is a totalitarian communist country, and in many ways, it's a lot of the money that has gotten out of China, we think is not coming back. It's similar to Russian money that fled the Soviet Union or Venezuelan money or whatever it might be. When a communist country gets into an economic crisis, we see many more a much bigger likelihood that there's going to be a currency crisis. So a China yuan currency crisis is one of the big macro themes that we have here at Crescat. They've created close to $50 trillion worth of credit in their banking system, just on balance sheet credit, and another almost equal as much off balance sheet credit. And it's just an unprecedented amount of banking asset expansion. And when you say $50 trillion of credit, we're converting that to dollars, and it's a 400% increase in banking assets over the last decade. But when you convert it to that to dollars, that's how it gets a value of 40 or 50 trillion dollars of credit. And what is the imbalance there? Well, the imbalance is the exchange rate in terms of converting it to dollars. Just one way of looking at how overvalued we think the yuan is today.
We'll have more with Kevin Smith when This Week in Money returns.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN.V. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Kevin Smith. Kevin, are the Chinese mainland holders of real estate in North America likely to sell off their properties in North America to cover their losses in China?
Well, we were talking about that a little bit just before the break, and it's something that I think you have to try to form your own opinion on, because is it going to be like Japan, where the money is able to come back to Japan, or is a lot of the money that has escaped from China really capital outflows that are not coming back? And a lot of the capital outflows that have come out of China have been truly illicit capital outflows, in the sense that China has capital controls. You can only take so much money out each year. So the money that's been pouring into real estate in many ways has been coming through illicit channels, through money laundering, through over and under invoicing schemes and trade accounts, through casinos and other even drug money schemes that are going on, that have been written about in some of your Vancouver newspapers there. And so you really have to ask yourself whether this is more like a communist country going through an economic crisis, where a lot of that money is really money that's ill-gotten in many respects, and has escaped and is not coming back. And on the other hand, I think there will be a lot of pressure under Xi Jinping including maybe some state-owned assets that have fled, that are able to come back. And regardless, when the China bubble bursts, the one thing we know we can speculate on with a much higher degree of certainty, and that is that all the money that had been flowing out is really going to be clamped down on. And so the drying up of the inflows into these housing bubbles, Canada, Australia, is likely to, we've already seen a lot of evidence of that already, and housing prices at the high end have already peaked in Vancouver and Toronto and Sydney and Melbourne. So we know that the capital outflow pressure is already really tightened up quite a bit from China, and so we know that's going to dry up, and that can't be a good sign for the housing markets in those countries. And if the outflows and if the money comes back and the Chinese are now trying to sell their properties, obviously that's going to create even more downward pressure on those local real estate markets. But one way or another, whether they're selling or whether the inflows are just drying up, we think that it's extremely negative for the record housing price to GDP, debt to household income, and other statistics that we use to measure housing bubbles.
Is that how China's economic troubles could affect other countries and cities like Vancouver?
I certainly think that's going to be a factor. Really, just the drying up of inflows from China, whether it's inflows turning into outflows or drying up of inflows. The huge influx of money coming from China, we think, is going to dry up.
We hear people from mainland China are pretty astute real estate investors, buying for the long term, yet they also like to gamble. What are your thoughts on that?
The high rollers that they call them, I believe, in China, or the whales, whatever they call them, a lot of those are tied into casino money laundering schemes, where and I'm not an expert on all the details there. You have to talk to Sam Cooper in Vancouver, but these folks are bringing in piles of cash, converting them into gambling chips, going in gambling for a little while, and then cashing in all their chips, and that's a way of laundering money, and that money is somehow getting recycled back into real estate. And I don't know all the ins and outs of it. In some cases, there's underground banks involved and drug rings, but the Chinese love to gamble. Well, maybe, but gambling is also a big part of the money laundering scheme as well.
Did lax lending standards in China provide the down payments for mainland Chinese to buy high-end foreign real estate with essentially zero down?
I certainly believe there is a lot of lax lending going on in Canada and in other countries, and we've seen what happened with Home Capital already, and believe Laurentian Bank has had some issues. But the big banks in Canada really have not seen the pressure come under them yet from mortgage defaults and delinquencies, and we think that's still in the early innings. But the big banks do have significant exposure there too. And I do believe there has been lax lending. I believe a lot of the Chinese money that's come into play is money that's been borrowed from the Chinese banks, and so the down payments that have been coming from China are already in the form of borrowed money, and the Canadian banks have been making loans on top of those. At least the Canadian banks might have the first lien. Maybe the Chinese banks are going to be in even bigger trouble.
Could China attempt to repatriate the money that's been laundered out of China and used mainly to buy real estate in other countries?
Well, again, we've kind of been talking about that, and we certainly believe that they will try. I think more than anything right now, the Chinese are trying to attract foreign capital inflows back into their country, trying to get foreign investors to invest money in China's bond market by opening up the bond market, and so they're exploring other ways of attracting inflows into China, and at the same time as a lot of the money has been flowing out of China through illicit channels. But will the Chinese Communist Party try to repatriate Chinese capital that's flowed offshore when they get into a crisis? I mean, absolutely, we think they will. Whether they'll be able to or not, I don't know. When a lot of the Russian oligarch money fled the former Soviet Union, did it ever come back? I don't know. I don't think so.
Yeah, it was invested in English soccer clubs. How much money has China printed?
When you look at the PBOC's balance sheet, they have created something like $5 trillion of assets at the kind of M0 monetary base level, and it's just in terms of PBOC balance sheet, they're the largest central bank in the world in that respect. And but when you look at the amount of money that's been printed on top of that through the fractional reserve banking system and all the credit that's been loaned among the state-owned Chinese banks, you get to another $45 trillion of banking assets and an M2 money supply that's somewhere in the 20 trillions of dollars, so the money printing really it's unprecedented for any country ever, and it's the largest monetary base, it's the largest M2 money supply, it's the largest banking system assets of any country in history, and it's the largest in all of those measures relative to the underlying GDP of an economy, and so that's just an example of the massive amount of money printing, credit creation, relative to the underlying income producing power of a country that illustrates that China is probably the largest credit bubble we've ever seen.
Is China attempting to buy up the world by printing lots of money?
I think that there has been, several $1 trillion of capital outflows from China to the rest of the world. I think the bigger problem is within China's domestic economy and in their own banking system tied to their own economy and their own depositor base. And really the creditor to the whole Chinese system ultimately that's holding the bag are the Chinese depositors themselves, and you have over 1 billion Chinese holding deposits in these banks that are for all practical purposes insolvent. They exist by making more new loans to companies and individuals that by and large can't pay these loans back, and the only way that the system keeps going is by making more loans. And covering up the non-performing loans, extend and pretend. Well, who's holding the bag at the end of the day? It's the depositors in the banking system. It's the Chinese themselves, and it's just one other, piece of the puzzle in terms of is China this great growth economic engine of the world, or is it just a Ponzi scheme and some kind of Orwellian nightmare that is playing out before us, and we think it's something more along those lines than China's some great economic miracle. It looks a lot more like a Ponzi scheme, and it's the Chinese themselves that are holding the bag.
We'll have more with Kevin Smith when This Week in Money returns.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Clark.Gold discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Kevin Smith. Kevin, how tough is it for people to move money out of China?
That's a good question. The capital controls that China has put in place over the last couple of years, and China has always had capital controls, are have truly slowed down the amount of money that's been pouring out of China, but it still finds a way to get out, whether it's through trade invoicing schemes, under invoicing or over invoicing of imports and exports, or through outright money laundering schemes through underground banks and casinos and drug rings, these are things you can read about and study, but definitely the amount of money pouring out of China has slowed down, and that's what's been putting pressure that's what was putting a lot of downward pressure on the currency that they've been able to at least slow down over the past couple of years, you have a pegged an essentially pegged currency, but it's supposed to freely float a little bit in a managed way. But you've had the current account surplus in China has been declining, and it's about to head into a deficit even, and so another imbalance that's been created by all the money that's been printed and the that's not able to really get out or escape. The pressure should be downward on the currency, but because of the capital controls, it's able to stay pegged. And meanwhile, the credit bubble inside of China just gets bigger and bigger and bigger.
What have you heard about the different ways they've been able to escape these currency controls in China?
I think we've touched on that a few times in terms of the trade invoicing schemes, the gambling, the other money laundering schemes that go on, and why does that exist? It exists because China's a totalitarian communist country with capital controls, and it is a credit bubble, and people are trying to get their money out, so they will explore all the different ways that they can, and they will find a way to do it. But ultimately, when a country goes into a currency crisis, and a country like China, which is involved, it's one of the largest global trade economies in the world, if not the largest, and you can't be involved in global trade and not have a currency that people can freely trade. And people can trade the Chinese currency. You can trade it through a U.S. bank, and ultimately, we believe that when a currency crisis is ultimately a speculative attack on a currency, whether it comes from within or from without. It's a combination of factors that just capital controls by the Chinese themselves are not going to be able to stem the tide.
Because of government influence, is the yuan comparable to other currencies?
Certainly not. It makes up a tiny percent of the SWIFT international payments system. Most global trade is still done in U.S. dollars, and Chinese yuan is not a part of that. So there's just a number of reasons why this currency bubble in China has gotten bigger and bigger and bigger, but the yuan is mostly piling up inside of China itself, not so much throughout the world. It's really piling up inside its own banking system. Again, the people holding the bag, we think, are the depositors in the Chinese banking system themselves. It's like, if you're invested in Madoff, for instance, and you've got a statement from him saying what your account is worth, but what's it all worth at the end of the day if you try to get that money out? And it's the same problem in China. If the Chinese really had to get their money out of the banking system, the banks, the banks would fold because there's not enough liquidity, there's not enough liquid assets and performing loans to make good on the claims that would come on their banking system. So what's going to be the trigger to for that? It could be any number of things, but social unrest certainly could play into it, and to some degree, and it's a really large imbalance, and China is an oppressive totalitarian country. Can you oppress 1 billion people and prevent them from having a run on their banking system? I mean, probably, and that's what they do. It's a police state. But is that the type of economy that's really going to survive and thrive? Now that we have Trump and Lighthizer, going after China for all of its violations of the WTO, and people think there's a lot of hope that we're going to have a big trade deal with China and everything's going to be fine, but there's so many violations of free market trade and intellectual property theft and forced technology transfer, and I find it very hard to believe that we're going to have a trade deal now that's going to save China, let alone save the global economic cycle today from a downturn.
Banks in Canada have been providing 50% down mortgages to foreign buyers. As the real estate bubble in Canada bursts, are Canadian banks at risk?
Again, the foreign buyers, largely Chinese money that's been pouring in, and the 50% down, we think a lot of that 50% down coming from the Chinese has been borrowed from the Chinese banks. The Canadian banks themselves, who are putting up the difference, the problem is that the value of the real estate that's being loaned upon, relative to the underlying ability of the Canadian economy to service those mortgages, and the strength of the household balance sheets at large in Canada. And it's not so much the Chinese themselves that are at risk. It's the average Canadian who has joined in on the real estate gold rush, and also maybe only put 10 or 20% down, and has also leveraged up to 170% debt to household income to participate in the real estate boom. So it's it just has a lot of the hallmarks of a typical housing bubble like we had here in the U.S., but bigger in Toronto and Vancouver by a lot of measures.
In a Canadian housing crash, are banks more likely to weather the storm compared to credit unions?
I think the big banks in Canada are holding the bag as much as the credit unions. The big banks are more overvalued, at least in terms of the big public banks, than some of the other opportunities among the smaller lenders in Canada. And so, like in the U.S. housing bust, when when the trouble hit, the big banks got hurt just as much as anybody. It's a similar situation, I think, in Canada. The big banks have much more of the debt on their own, mortgage debt on their own balance sheet, as opposed even compared to the U.S., where we had a big securitization market. But of course, the big banks in Canada will be bailed out by the central bank, but that doesn't mean that the equity stockholders in the banks will be bailed out, much like here in the U.S. when your average bank, large bank, is trading at about 1.7 times book value, and the book value is still largely inflated because we haven't seen the big write-offs yet. It doesn't take much to see that when you get into a bear market and book values go from 1.7 to 1 times book is getting written down at the same time, it's pretty easy to get to a 50% kind of a correction in the valuation of bank stocks. Doesn't mean that the banks are going to go under, but it does mean that they are overvalued and likely to go into a cyclical downturn.
With President Trump bringing manufacturing back to America, could U.S. stock markets be in for an extended upcycle?
Well, I think one of the issues with the trade war with China right now is, and we do think it's a trade war. We think it's beyond a trade war. We think it's a Cold War. But one of the issues is the tremendous supply chain that's already been embedded into China and Asia among U.S. companies, and so the idea of bringing manufacturing back to the U.S. is great, but I don't think you get from point A to point B without a lot of disruption in between, given the embedded supply chain issues that could cause a lot of disruption in the near term.
What do you see ahead for global stock markets?
We are most concerned about stock price valuations here in the U.S. The U.S. Across 8 different fundamental measures that we look at, U.S. stocks are historically the most overvalued they've ever been. Really, that was back in September that they reached the peak in terms of valuations, whether it's measures like market cap to GDP, EV to sales, EV to free cash flow, price to book. A lot of these measures at the median or in aggregate are the highest they've ever been, and so that's the U.S. market, and the U.S. makes up the biggest percentage of the global equity market cap, and we think that it is a global economic cycle that we're in. It's been led by the Fed and global central banks since the global financial crisis, who have created a $20 trillion collective M0 monetary base, and what it's only served to do is to pump up asset bubbles globally, whether it's corporate credit, real estate, or equities. We are at record historic valuations, but more than anywhere, that's evident here in the U.S. We believe emerging markets with the problems in China are going to be subject to equity market downturns as well. China, of course, and emerging markets already, the bear market already started in January of last year, but we've been recently through what we think very strongly is only a bear market rally that has seen year to date markets in China up over 20%, and in the U.S. up in the teens, and globally, what looks to be a bear market rally. In the U.S., we're retesting the all-time highs from only a few percentage points off of where we were back in September, and I think people forget already what it was like in the fourth quarter. There's a lot of euphoria and bullish optimism again, hope of a second half rebound in the economy at the same time as all the economic indicators are turning down, and the earnings for the first quarter in the U.S. are going to be down year over year. It's going to be an earnings recession, and the estimates for the full year keep trending down. Employment trends are starting to weaken. So there's just a number of economic indicators, a divergence in consumer confidence, and all the yield curve inversions that we've had popping up recently. There's just so many different economic signals that portend, from record valuations to economic timing signals, that we are still in the very early stages of a global equity bear market, and particularly for the U.S. stock market.
Have we reached peak credit?
Well, to keep the global economy growing, global credit needs to keep growing, and that's what central banks have been trying to do. It's a balancing act, because they have to support the markets with low interest rates and money printing. But we've been through a monetary tightening cycle where M0, where global M0 has actually been declining, and global M2 has been growing at a declining rate, and I think it actually just went into decline in the past quarter. And so, these are big signals. If we cannot grow, if central banks cannot keep global credit growing, you cannot have global economic growth, and it's one of the signals that we're seeing that portends a global recession.
Are central banks responsible for creating asset and credit bubbles?
Well, central banks, we think, have been, and they're certainly part of the issue. Investor speculation, and it goes right along with it. There is a business cycle. There's fear and greed play into it. Liquidity plays into it. Central banks have created liquidity to keep global credit growing, and none other than China has created even more credit growth in the last decade. And so central banks have been part of it. It's their job to try to smooth the economy and extend the business cycle, but they cannot repeal the business cycle, and part of the problem with just extending more and more credit and printing more and more money, keeping interest rates too low for too long, is you get too much speculation, too much greed, too many zombie companies. I mean, look at all these supposed economic disruptor companies that are out there that don't make any money. Lyft just went public, for instance, and it's still losing something like $1 billion. I don't know what the numbers are exactly on Lyft, but they're still losing money, and these companies are going public, and what do they call them? The private companies that are valued at more than $1 billion. They're all losing money and are valued at multiples of 10 and 20 and 30 times revenues. So some of these companies will be great disruptor companies, and they might be the next Amazon, but others might just be the next zero to play out in terms of stock price performance, and so when the liquidity tide goes out, when the credit cycle goes out, the zombie companies are revealed for what they are.
Kevin, how can people find out more about Crescat Capital?
We have a website, crescat.net. People can send an email to info@crescat.net. They can go onto our website and subscribe to our newsletter, which we highly encourage. We have a lot of information on the web, our past letters and our research. We're active on Twitter, and so we suggest you check that out as well.
Kevin, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Kevin Smith, CEO and founder of Crescat Capital in Denver. Coming up, Lobo Tiggre, next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Lobo Tiggre from the independentspeculator.com. He's speaking to us from Puerto Rico. Welcome back to This Week in Money, Lobo.
Thanks, Jim. Good to be back on the show.
Lobo, so much is being put on the trade talks between China and the U.S. Are they going to pan out, and are they that important?
Well, I'm not going to handicap the pan, or at least the timing. I will stand by what I've said before, and I think on your show, your listeners may recall. Clearly, both sides do want a deal, so I think a deal gets done. Whether it's a meaningful deal, whether anything really changes, that's another matter. I don't want to put odds on that. But the second question you ask, I think is actually quite important because this has been going on for so long, and every time Trump tweets something good, the market goes up, and he tweets something bad, the market goes down. And I've seen talking heads in the financial media saying, oh, this is old news, we don't care anymore, we've heard this before, yeah, probably. But you know what? The markets respond, and strongly. We could see that today in the movement in the major indices in the U.S. at least. We could see the markets responding to Trump's remarks. When he says something positive, they like it. When he says something negative, they don't. And that's a testament, I think, to how important it really is. The fact that people can't afford to ignore this news. You may be tired of it, but it doesn't matter whether you're tired of it. The market doesn't care how tired you are. If something is going to threaten business or boost business, that's relevant to the values that you're pursuing.
Well, you have the world's two biggest economies, I feel, kind of circling each other like sumo wrestlers.
Yes, that's a good way to put it. I interviewed a friend of mine who's a money manager for very deep-pocketed old money in Europe, and he's based in Switzerland. And we were talking about things, and I wanted to get his European perspective on the global markets and things. And it was interesting. I thought, Brexit would be one of the things top of my mind. And he's like, that's really a sideshow. We're really most concerned about the U.S. and China. I mean, these two behemoths collide in a bad way. That's bad for all of us.
On Brexit, it seems everybody wants a perfect deal. They've had, how many now, 12, 13 different proposals voted down? They don't know what they want. What does that mean?
Oh, well, we could point fingers, but we have sides entrenched and unwilling to compromise on our side of the pond as well. So I don't think it's a peculiarly British failing here, but clearly there are constituencies that have told their elected representatives, this is what we want, and we absolutely do not want to hear of any compromise. And that's made things really difficult. Even though everybody gets that a no-deal Brexit is likely to have very high costs, and I think very few, let's say, well-informed individuals really would just say, yeah, to heck with it, no deal is better than staying in or whatever. I think most informed people over there, whatever their side is, want to see this come to, play out in a managed way as opposed to a chaotic way. But people are so entrenched. It just seems like it seemed inconceivable a couple months ago that actually a no-deal Brexit could happen. Now it seems like the most likely outcome, even with Theresa May meeting with Coburn over there. And that may actually be scarier than the Brexit. Like, whatever happens with the Brexit, if the path to that solution is a deal with that Labour Party, I'm not sure he's quite as bad as AOC, or good depending on your perspective, but he's pretty far out there, and that's quite a concern. If he gains more power as a result of the Brexit deal, that's a real concern for business in the UK and potentially the larger areas surrounding. And even if he doesn't, if it strengthens his hand so that Labour wins in the next elections in the UK, that has serious financial, he can undo the Thatcher revolution. I think that's his vision.
Well, I know the small business rules in Britain are tremendously aggressive and progressive, where they don't want you to have to be burdened with taxes for for some period, maybe 5 up to 10 years, where unless you're making a decent profit, we don't even want money from you as the government. Just get in there and get it established. Would that stay if Labour got in?
Right, and remember, I mean, Britain, after World War II, took a real hard left turn. They kicked Churchill out. They nationalized industries left, right, and drained the wealth out of the country until, honestly, I don't think it was a breathtaking wave of reason that swept through Britain and brought Thatcher in. It was desperation. Things were so bad. Even, a libertarian-minded politician could get elected over there. Somebody who quoted, Hayek's Road to Serfdom could get elected in socialist England. That was really quite striking. So a lot of those people are still around. A lot of their ideas are still around. So I think that's a serious concern for the global economy. A hard left turn in the UK could be much more disruptive than the Brexit itself. That remains to be seen.
Is NAFTA 2 in danger? We have the Democrats saying they want changes in Mexican labor laws. Canada is worried about the continued steel and aluminum tariffs. And so we may not ratify NAFTA 2. Is this not a done deal yet?
I'm gonna pass the buck on that one, Jim. That's not something I look at too closely. I mean, I guess my overall comment is that it's a renaming of existing deals. I think, again, the players here don't really want to rock the apple cart. The real question there, the fundamental question, unfortunately, isn't really about business or tariffs or international trade. It's about what are the election issues in 2020, and what does Trump think he needs to say to feed his fan base, and what do his opponents feel they need to say? And I'm not sure that that's an issue that really is going to bubble to the top there. It sure looks like the healthcare issue is going to be much more important. Of course, immigration again. And Trump clearly, I think, wants to bring these negotiations with China to a fruition before the election. I think he sees that as an important deliverable for his fan base.
We'll have more with Lobo Tiggre when This Week in Money returns.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Lobo Tiggre. Lobo, what's going on with uranium? Is it bright and shiny again?
We've talked about that. I think the overall answer is yes. We have seen since the bottom in 2016, late 2016, a series of higher highs, higher lows going forward. That pattern remains strong, though we are seeing a correction right now. And maybe some people will be concerned about that. I'm not. The fundamentals are very, very strong. The technicals haven't seen a breakdown yet. And in my mind, that makes the current retreat buying opportunity in some place. And then on top of that, of course, there's this whole Section 232 investigation going on in the United States, which I think presents investors with what we call asymmetrical risk in this particular space. If I'm right about the fundamentals for uranium being solid, and if I'm right that the market has finally taken a turn upwards, nothing goes up in a straight line. So if we're not concerned about the pullback we've seen in the last couple of weeks, the normal correction, fine. There's very little downside in that market space, but there could be extra upside for U.S. uranium plays or Canadian companies that have properties in the United States if the U.S. were to make a determination that it needs to foster and encourage the domestic uranium industry, which it really could. I mean, I personally, being a free market advocate, don't think the government should tell the utilities where they should buy the uranium from. The market should solve that problem, which I think it has done a fine job of over the decades. I'm not worried about it. But, it is what it is. Trump has his America First agenda, and I can certainly see how from that mindset, the fact that the U.S. generates 20% of its power with nuclear power, and it gets more than 95% of its uranium from overseas, those suspicious Canadians and the round bacon that we've talked about, they could cut us off. Never mind Kazakhstan, what a crazy place to get uranium from. I can see where an America First agenda would say, you know what, we really need to have a secure domestic supply of something so vital. And let's not forget, this isn't just about the electricity. Maybe the green revolution will eventually eat uranium's lunch, some many years down the road. But there's also the military use too. You've got nuclear reactors underwater and on the water as well, and you've got other uses. Trump is scrapping nuclear treaties with the Russians, so we could see a new nuclear arms race, and those guys aren't going to report, what their inventories are and what they're doing. We'll just see prices move as they start buying. So I see I wouldn't say a win-win, I would say a win-win more kind of balance here, where the fundamentals look good, the technicals remain sound. I think uranium is heading upwards, and on top of that, U.S. uranium projects could add extra value in the near term for their companies and their shareholders. That Section 232 report on this uranium question is due on Trump's desk on April 14. He may or may not react immediately, but depending on what's in there and what he decides, we could see something, quite significant by this summer. And if not, the fundamentals are still on the side of uranium investors.
What about places like China, which plans to open, I think, hundreds of atomic reactors? Japan refiring the ones that were closed during the tsunami. What about factors like that for the worldwide demand for uranium?
Well, those are part of why I say the fundamentals are strong for uranium. And we have seen, after Fukushima, there was a big pause, a big reassessment. It was reasonable to question how many of these planned reactors would be brought online. But the Chinese did reassess, make adjustments, and they're going ahead. They have doubled their reactor fleet more than doubled it actually, since 2014, after Fukushima. So clearly they have not stopped. Now, maybe they'll slow down, maybe they'll do different things. Nobody can really know. Having plans for all these different reactors is one thing, being able to actually implement them going ahead is another. But clearly they want to. They haven't stopped, and they're not the only ones. We could say, broadly speaking, even the U.S. is looking at building a new plant for the first time in forever. But even if they're slow, and even if Germany, doesn't want any more, and even if South Korea wants to try to phase out its nuclear power dependency, the BRICS countries are certainly going full steam ahead, and I think that's part of why I'm so bullish on uranium. Now, that having been said, it's clear that the world is not short on uranium. The big producers had to voluntarily cut back production, like OPEC. They're not a cartel, but everybody could see the writing on the wall. They could make money at spot prices. So, Canada's Cameco shut down their flagship mine there at McArthur River, put it on care and maintenance. It's not because it wasn't a good mine. It's one of the richest uranium mines in the world, if not the. I don't know if it's got the top 1 or 2 spot, but it's way up there. It is a fantastic deposit. But why would you mine that out and lose money when you could bank it and make money on it in the future? So it makes sense for them to shut down. In Kazakhstan, the world's #1 uranium producer, they also voluntarily cut production. But like OPEC, I worry when prices respond to voluntary supply cuts. Voluntary supply cuts can be reversed. Not quite as quickly in uranium mines as oil fields. Oil fields, you could turn a valve off and turn it on. In some cases, it's not quite so simple. But with a mine put on care and maintenance, it can take longer to start it up again. It's not just a flip of a switch. But still, the uranium is still there, is what I'm saying. So I think I'm cautious about the uranium price and the supply and demand fundamentals going forward. Most of the analyst projections are for widening gaps between supply and demand, with demand far outstripping supply on up through 2030. But these models are based on a lot of assumptions, and they might be right, but I'm just very cognizant of the fact that uranium is not in short supply, and the current constraints are based on voluntary cuts. I think investors should keep that in mind. So I'm very, very bullish on uranium, but in the near term. Like this year, I think is a shoe-in, probably 2020. After that, I don't want to sound like Jerome Powell, but I'll be data dependent on that.
Well, so many countries around the world, especially China, have mandated electric vehicles to fight their air pollution. they've probably dammed up every river they can for hydropower, so what other choice do they have for energy?
I don't think that's true about the hydropower. I was just looking at a map of like some 20,000 locations around the world that could be used for, pump uphill when you have electricity, let it drain downhill when you need it kind of power solutions. I'm not an expert in hydropower, so I don't want to say too much, but I'm just saying I think there's reason to question whether that's true about the hydropower. What I don't question, and I think you're absolutely spot on, is that China knows it has a pollution problem. They're doing everything they can to go electric, and firing up coal plants to power these electric cars and buses. Obviously that's not going to help. So I do think that they see, and the evidence supports that they see nuclear as part of their greener future, and they're going in that direction. I was just reading, they're putting almost 2,000 electric buses on the road every week in China. Every week. And those buses, electric buses, they're freaking huge batteries. Never mind, 100 kilos in a car. These things have like a ton of copper in them and just gigantic batteries. And they're putting almost 2,000, like 1,900 of them every week on the road.
That's an incredible number. And again, something until you told me, who knew?
Well, I do this stuff almost 24/7. I live, eat, breathe this stuff, as they say. That's part of the service for my subscribers at independentspeculator.com. I try to follow these trends closely and report on what I'm seeing. There's even a free sort of market-wide research that people can sign up for, a free weekly email blast. I don't spam people, just try to inform them.
We'll have more with Lobo Tiggre when This Week in Money returns.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Lobo Tiggre. Lobo, what's happening with the gold juniors?
Well, it's interesting that you ask. I was asking myself this question the other day. I said, self, who would really know if things are starting to turn around? And I thought, well, a driller would know. The companies are always going to talk about the great things they're doing. But when they actually do something that adds value for shareholders in the ground, they need to drill. They need to find the gold. They need to explore, and, chip samples on surface aren't really going to do it. So I talked with Fred Davidson just yesterday. He's the CEO of Gold Drilling, and I was trying to see if he could give me some good news, be a leading indicator for the gold sector. And unfortunately, I cannot tell you yes. I can't say that he said, yes, bookings are up. He did sound a little bit upbeat. He says he's gotten more calls in the very near past. So maybe that's optimistic, but it's not like he's unable to keep up with all the drill bookings. So we're not seeing that real proof in the pudding yet there. That's not the good news that maybe your listeners want to hear if they're long and hoping for their shares to go up. But I would say that there is a bright side to this, a gold and silver lining, if you will. And that is that under market conditions like this, the punters out there and the pure promoters, they're going to have a hard time raising money. And we hear this all the time. Oh, we can't explore. And Fred was telling me, the bookings are not soaring because people can't raise money. So that's not comfortable for you if you have stock in a company that can't explore. But it's very good news if you're looking to buy, if you are looking for, all right, who are the best guys out there? Well, the ones who can raise money, that's telling you that in this tight market where a lot of the flighty liquid capital has gone off chasing pot stocks or bitcoins or whatever,
the smart money that understands mining, who are they willing to fund? And I think that's actually quite useful. If I'm looking to deploy capital, and actually I am, particularly in silver right now, I'm looking for a good silver story to put some money into, then who's able to raise money tells me a whole lot about the quality of the plays on the field.
Would person be better off right now to take a look at gold prices or silver prices and decide what am I going to sink my money into, or should you diversify on that?
We may get some hate mail if I answer that, but a lot of people like to look at the gold-silver ratio and say, oh, silver's so cheap compared to gold, silver's got to go up. I think we've mentioned this before. I have looked at this extensively, and I have found basically no predictive power whatsoever in the gold-silver ratio. If it gets really extreme, it can stay there longer than you think. When it does narrow, it can narrow by gold not going up as much as silver rather than silver coming up to catch up with gold. So it doesn't really tell you what's going to happen when the narrowing, finally happens. So, not a big fan of that. What I will say though is that it's similarly well documented that when the precious metals rally, gold tends to lead and then silver tends to outperform. And we've seen this in both from 2001 to 2011. We saw it halfway there from after the crash of 2008 on through 2011. We saw it in 2016, that big rise during the first half there. Gold starts first. When the precious metals catch a bid, gold is the one that people look at. But silver moves with gold, and it's more volatile, and it just tends to zoom on up. So I am bullish on gold this year, and therefore I am very bullish on silver. I think between silver's greater volatility and the fact that it is relatively oversold, and also the macro picture, the global economic concerns, the effects of the trade war, most silver is produced as a byproduct. So you could have precious metals prices going up, and you could have supply of silver not change at all if it's coming mostly from copper mines or zinc mines or something. So we actually could see silver go into one of its little mini-manias here if prices start rising and the supply doesn't respond. I'm not promising that. I'm just saying it could be there. But meanwhile, since I'm bullish on precious metals anyway, I don't need that mania. If it happens, great. It turbocharges my result. If not, I'm okay with precious metals simply rising.
I had an investor suggest to me, maybe you should just, for fun, buy 2 or 3 ounces of silver a month just as a matter of habit and see what happens. And he said in the long run, you'll probably be happy. Is that true?
I can tell you from personal experience that has done well for me. There's a famous story somewhere on my website. People can search for Mexican peso on my website. You'll probably find this story. But I used to do that, and I had actually a coin collection. I started as a child and had a bunch of old Mexican silver pesos in there. And long story short, I had a major post-divorce financial meltdown some years ago. Just a huge financial catastrophe a couple decades ago. And, you regroup, you get a new job, you do what you gotta do, you liquidate everything, and you pull through. But it got so bad at one point that I had nothing left but my silver collection. And I literally fed my family when I had nothing else. It was the asset of last resort, and it did exactly its job, those old silver coins. But the funny part, the icing on the cake to me in this story is that they were Mexican silver pesos from like the 1950s or so, and they weren't pure silver. They were partly silver. And in that time, from 1950 to about 2000 when this happened, 1999, the peso had been devalued like 6 times, and frequently like 10 to 1. Or there was one like 5 to 1, but multiple devaluations. So if you had held a peso from 1950 to 1999, it would be almost completely worthless. Maybe as a collector's item, you might sell one, but the peso would be like 1/100,000th of a peso or something by 1999. But the silver pesos, they weren't solid silver. They just had a little bit of silver in them, but it was enough that it had some value. And I was actually in Mexico at the time, and I took them to a pawn shop, and the guy gave me 1 new peso for my old silver pesos. So the silver peso was literally worth 1 peso almost 50 years on. It was inflation proof. That's exactly the whole concept of wealth preservation behind real money, precious metals. So I personally experienced, that wealth preserving capacity of precious metals, and it saved my butt and my family at the time of dire need.
Lobo, thank you so much for chatting with us.
Always a pleasure, Jim.
My guest has been Lobo Tiggre from the IndependentSpeculator.com. He was speaking to us from Puerto Rico. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Kevin Smith, and Lobo Tiggre. And thank you for listening. If you have any questions for the show, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
It's always great to be on the show, Jim.
Larry, a lot of positive news rolling in the last few weeks.
Well, we've definitely had that. It seems to all come in a cluster like that, but some of this we've been waiting on for a long time. And I think the biggest thing that has happened is we finally got the patent issued and the patent number, so I imagine we've got all kinds of battery manufacturers and car companies and people that are interested in our patent going through that, because it's all published out there now. And that's a big breakthrough for the company. But we've gained a lot of credibility in the last couple of weeks with the announcement that we are participating in the DOE battery recycling project. So that's, we're a private company. We're a Canadian company, and we're one of the first to do that with the DOE. And that's big news, and that's gains us a lot of credibility, although you would never know it looking at the market. It seems like there's an endless supply, being offered out there. If you look at the bid and the offer, you'll see the offer never changes, even though 400,000 or 500,000 shares change hands. But, that'll end sooner than later, and, we'll start the shareholders will reap the benefits of the hard work that's being done by the management with Cometco. So, those are two very important, announcements that we've made. We'll be filing for another patent here probably in the next 3 to 4 months, which helps streamline our process. And we're waiting for approval on the patent, the CIP that we basically put in as of March 20th. So we filed that CIP. We expect to get a patent issued. We've already had deficiencies on that, and I can tell you they're very, very small. So we're hoping that that will be granted here in the next couple of months. So it's been a very busy time for the company. We're very excited to be part of that program in the U.S. We're looking in to see if there's a chance for us to be eligible for the $5.5 million that's up for grabs from the DOE on the recycling. We certainly have a process that the pilot plants have proven up to this point, stages 1 and stages 2. And we're moving on to the next stages. That will be a separate announcement by itself. So what I can say, Jim, is that, we've had a interesting week. We've had some interesting announcements in the last 3 weeks, and not just interesting, but milestones for the company. We're getting interviews, on a regular basis here. We're getting new interest in what we're doing. certainly everybody wonders about where we're going to get our supply from. But, we get offered supply every day, and, it's by small recyclers mostly. It's not from the car companies themselves, I guess, but they do put their stuff out to the recyclers, and the recyclers are reaching out to see if they can maximize the return. So they've been contacting us, individuals all over the world, and so it's I'm not really concerned about supply. It's what we can deliver, the deliverables that are important. We've got a business that somebody had written up here a little while ago that it was a $23 billion business in recycling by 2025. That's huge, and we're sitting at the forefront of it. We're certainly been transparent about everything we've done. Our competition has been less than transparent. And now we've got it patented, and, we do know that we have a process that works. So it's just convincing somebody to do that. And, people are saying, well, what are you going to do about the $10 million plant? I've got other thoughts on that. I think that this plant could be up as high as 10 tons a day rather than 3 tons a day for nominally the same cost, maybe not much more. And, because you're looking at having to fabricate and manufacture these pieces, it doesn't cost that much more to go to a bigger size. So, what's the cost going to be? I think that number that we have out there was a very rough number, but I'm hoping that we can do at least 10 tons a day. And we could actually do up to 35, 40 tons a day from a supply that we've identified on scraps. And, that's now you're coming into the hundreds of millions a year. So, hey, this is exciting. I mean, I'm just perplexed that nobody's seeing the commercial opportunity in this. Although you're starting to see people are now beginning to write that there is some commercial potential there, and really we recognized that 2.5 years ago, or we wouldn't have done spent the millions we have on getting to this point. So I just wish the shareholders a great weekend, and you better take a look at the stock, Jim. It won't be here forever.
Larry, for people who are new to American Manganese, what are you all about?
Well, American Manganese is a company, the critical metal company that's taken the manganese project in the U.S., in which they developed a proprietary patented process, used that as the cornerstone to launch their efforts in recycling batteries, and that's been successful. We're under the website of AmericanManganeseInc.com. We're traded on the TSX Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM. Our website, I think I've already given that, but you can reach me at 778-574-4444. Or you can email me at LREAUGH@AMYMN.com.
Larry, thanks a lot for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on April 5th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. My guest is Jim Pettit, CEO and President of Aben Resources. Welcome back to the show, Jim.
Thank you very much, Jim.
Has it been a busy start to spring for Aben?
Yeah, it has been behind the scenes. Other than marketing, I've started marketing in a pretty big way. These interviews, I've got one a day for the last few weeks. As far as what we're planning going forward, it's been really busy. I've got one crew of geos working on the Justin, getting it up and ready to go. And then the other, Cornell and the guys are getting the work ready to go on the Forrest Kerr. And I mean, that's pretty extensive what they're looking at there at the Forrest Kerr. But let's just chat about the Justin right now. It's coming together nicely. I've got, we're hoping to get in there beginning of June, like a month earlier at least than the Forrest Kerr. We've got about $1.2 million, $1.3 million budget for 20 holes drilled by a RAB drill, which is a rotary air blast drill, a drill to 50 meters, so maybe 70 meters. We can get about 20 of them done from where we were trenching last year. We've got a 250 meter strike length of trenches. And the results from there were all, pretty encouraging. So we want to go and get at it with this RAB drill. This is what White Gold's using over in their neck of the woods in the Yukon. And so we can get that underway pretty quick. That can move quick. You can do 20 holes. We could be done, in 30 days. Plus, we've got a diamond drill. We want to go do a few more holes in the old POW zone, which we haven't drilled since 2012. But we've got a big intrusion-related gold system that we're looking at there. And this area where we're going to use the RAB drill is called the Lost Ace. It's about 1.5 kilometers to the west towards Golden Predator's Three Aces project. And they look eerily similar, the Lost Ace and the Three Aces. So, we think that's worth looking at because it could be associated to this intrusion that we've got at the POW zone. I think it's a major intrusion underneath the whole area, and that could be causing this, these events, these high-grade veining events that we're looking at Lost Ace. So that's kind of exciting, and we're also going to do $200,000 worth of field work up there too, other than just drilling. So that's an interesting project.
Jim, for people who are new to Aben, what are you all about?
Well, we're a gold exploration company, primarily looking for, like, for example, in the Golden Triangle, our Forrest Kerr project. It's high grade gold potential, and we're in an area that has shown us a fair amount of that. Right now, it's year 3, really, third year drilling, and last year we drilled 10,000 meters. We'll probably do that again this year. But we've got 3 really good targets to start this year with, that we've gleaned from all the work from last year. Tremendous amount of work, a little bit of 3D modeling too. So, that north of the north boundary zone's showing us something that we didn't hit last year, and we should be looking at seriously. South boundary zone did show us some pretty good results. A little different than the north boundary zone, lower grade, but very broad intersections. So, we want to go back in there. We may just have constrained ourselves by only having 1 drill pad location because we only had 9 locations last year to work with. We've got approval now for 40 new pad locations, so we can get at different angles in the areas that we didn't have stellar results. We can go back in and let's see if we can put in a better hole and come up with better results. And we've also got that old Miranda hole. And that only had 1 hole fired at it. 2017. It was a very long hole. The pad was located well to the north, and it was kind of like spearfishing. You want to go back and get it into that same zone where that high-grade Miranda hole was. That was about 10 meters at 38 grams. And we're going to go in there with some new pads and get in a little closer and try to see what we're shooting for there. I think we got a better idea of how to approach it, given all the work we've done this past year. So we're pretty excited about that too.
Jim, where are you traded and where can people get more information about Aben?
We're listed on the TSX Venture under the symbol ABN, on the OTCQB under the symbol ABN.AF, and the Frankfurt Exchange E2L2.
And for contact information?
Just check the website.
Jim, thanks for the update.
Okay, bye.
I've been speaking with Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on April 4th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of House Street Media Incorporated.